Hi, welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what investors are thinking about right now and how that fits in with the right portfolio. Now, in the last few weeks, obviously, everyone's been very much focusing on the tariff from the Trump administrations and how that impact on both the US and global economy, and of course, on global trade. Now, as we move into the summer months, we could see another key policy decisions being made in Washington, and that is the budget. So there's been some concerns over the long-term sustainability of U.S. federal government debt, and of course, recently we've had the Moody's downgrade. So to share with us some of the developments in Washington right now, and what does that mean for investors, I'm delighted to be joined by Meera Pandit, our global market strategist based in New York, who share with us a lot more on this topic. So Meera, thanks for joining us today.
Thank you so much for having me, Tai.
Now, at the high level, maybe we start off with what's being discussed in the Congress with this reconciliation bill when it comes to the budget.
So at a high level, the so-called One Big Beautiful Bill has passed through the first chamber of Congress, the House of Representatives, and is on its way to the Senate for debate and editing. Essentially, this One Big Beautiful Bill is the vehicle through which the administration would like to pass meaningful tax cuts of about $3.8 trillion, along with meaningful spending cuts to fund some of those tax cuts. Now, the reason they've done this through a reconciliation package is because it doesn't require a full, meaningful majority within Congress, so they don't need as much bipartisan support. Instead, it's just a simple majority to get through some of the signature campaign promises of this administration.
Great, that's an excellent overview. So let's drill into some of the details. What are some of the line items that you are focusing on from this proposal? And of course, what is the position of the Republican Party and perhaps more broadly the Congress on these items? And what's the fiscal impact both in the short run, in the next couple of years, as well as in the long run, maybe the next 10 years or so?
Underneath the hood here, again, it's about $3.8 trillion in tax cuts, and that includes a full extension of the 2017 Tax Cuts and Jobs Act. It also raises the SALT deduction from about $10,000 to $40,000. It critically adds on no taxes on tips and overtime. It has some additional tax deductions and credits for the elderly and children. And then on the corporate side, while it doesn't include that tax cut from 21% down to 15% on domestic producers, it does have some of the 2017 Tax Cuts and Jobs Act corporate-related tax benefits that have largely faded out. So things like 100% bonus depreciation for equipment and domestic R&D expensing. However, it funds this by making some pretty significant spending cuts on things like Medicaid, which is aid for lower income families, and SNAP benefits, which are specifically around food benefits for lower income families, which may prove to be a sticking point as this moves through the Senate, because those types of cuts are pretty unpopular. It also includes a phase out of various tax credits from the Inflation Reduction Act on things like renewables and electric vehicles. It includes some degree of spending towards the border in order to think about some of those immigration policy agenda items, and also certain provisions on student loan reform. And again, some of these items may be sticking points in the Senate, so this is not the last version that we've seen of this. Now, in terms of the fiscal impact, it could be pretty meaningful. These reconciliation packages can only make changes that are within a 10-year budget window. And what you've seen in terms of how they've constructed this is a lot of these tax cuts are only for part of the time, out to 2028 or 2029, whereas the spending cuts are for the whole period. So before this official bill was released, the Yale Budget Lab estimated it would be about $3.4 trillion in terms of higher debt. But if some of those extensions to tax cuts were made permanent, which they likely would be because it's hard to then have a big tax hike in 4 or 5 years' time, then it would cost closer to $5 trillion. The Committee for a Responsible Federal Budget underwrites these estimates, and I think they have about $3.1 trillion if some of these tax cuts are temporary versus $5 trillion if they are more permanent over the next decade. Now, the Congressional Budget Office has scored this at about 2.3, 2.5 trillion over the next decade, so coming in under that. But overall, we're likely to continue to see some pretty meaningful deficit expansion over the next decade.
So I mentioned earlier that Moody's recently downgraded the U.S. sovereign rating from AAA to AA+. How does this downgrade fit into the context of these changes?
The Moody's downgrade was not necessarily unexpected. Perhaps the timing was not necessarily what we thought, and yet it was essentially inevitable, because if you think about the major ratings agencies in the U.S., S&P downgraded U.S. debt back in 2011, Fitch downgraded U.S. debt back in 2023, so this was a matter of when, not if. The timing, however, has been a little bit different, because the last two times you saw the downgrades happen in August after debt ceiling standoffs were resolved, and this time around you're seeing it before we have resolved the debt ceiling. And so it's somewhat of an indictment overall of our federal finances, and an acknowledgement that the ratings agencies have a pretty bleak assessment of where we're going to go from here, and our ability and really the political will to make progress and resolve some of these items as it relates to debt and deficits. Just to put this into context, our deficit as a share of GDP right now is about 6.4%. Over the last 50 years, it's been about 3.8%. So it's moved meaningfully higher, and you're starting to see more of a reaction from bond markets. And ultimately, while we do not expect the U.S. to default on its debt, it's going to have longer-term consequences, and this is just not running at a sustainable level. So this Moody's downgrade is very much acknowledging these dynamics.
Okay, so President Trump seems to be quite keen to push this through rather quickly. I think initially they want to have a bill that's workable by Memorial Day, and then eventually everything wrapped up by the 4th of July. But it does seem like that timeline is slowly slipping. What is the realistic timeline for this bill to get through the Congress?
The House was able to pass this bill prior to Memorial Day, and they've now sent it along to the Senate. So over the month of June, the Senate will debate and revise this current text of the bill. And there is a pretty wide gap between what the House's aims for this bill are and what the Senate's are. So it could take some time for all of these details to be ironed out and for the Senate to come to some sort of consensus as it relates to some of the House text. They want to get this to the president's desk by July 4th. That seems a little bit ambitious, so you're probably going to see some slippage in the timeline there. So instead, we could potentially see something early August prior to the Senate's and the overall Congress's recess. So they might try to get it in there before vacation, and this aligns neatly with the timeline around when we could run into some debt ceiling issues in terms of when we hit the so-called X date.
Another question we get a lot from APAC clients is on the debt ceiling. So it seems like their general expectations or estimates is for the X date to take place sometime in August. What do you think? And what is the risk of the Congress failing to agree and therefore the U.S. fail to raise the debt ceiling?
U.S. Treasury Secretary Scott Bessent says we could reach the X date as soon as August. Again, I do think that's a somewhat conservative estimate. And just as a reminder, the X date is when we would essentially run out of money to fund the government. So we've hit the debt ceiling. Essentially, from now until when we run out of money, what we do is we employ extraordinary measures, they're called. We basically use the money that's left over in the Treasury General account, which is our checking account at the Federal Reserve. And there are also some various accounting gimmicks that free up some headroom. Now, what is part of this One Big Beautiful Bill is a $4 trillion raise to the debt ceiling, which would give us a nice long runway before we run up against it again. So that is something that's in here and creates a little bit of urgency around when this package gets passed. We would expect that it is included it does pass, it does get through, and we do avoid a default on government debt, which we have never seen before, although in recent years we've been getting closer and closer to that X date before we have resolved things. So we don't expect a default, but overall there are going to be longer term consequences of excessive debt and deficits and continuing to get closer and closer to this debt ceiling every couple of years.
So with all these changes in mind, I do understand that these are up for changes or prone to revisions. But what's your expectations on this reconciliation bill and its impact on the U.S. economy and any potential response from the U.S. Federal Reserve?
In the short run, what we could see as this bill is passed and come into effect in early 2026 is some stimulus to the economy, because the extension of the Tax Cuts and Jobs Act remains status quo on taxation, but the additional sweeteners of things like no taxes on things like tips and overtime would cause some degree of economic stimulus potentially. Now, on the other hand, you do have cuts from a benefits perspective to lower income consumers, so maybe that's a bit of a countervailing force, but you could see a potential uptick in growth and maybe even an uptick in inflation as you see some of these policies come into effect. Although, as I mentioned, the persistent debt deficits running up against this debt ceiling probably means in the long run we're likely to see slower growth and higher inflation as we struggle with some of these unsustainable federal finances. Now, when we think about the Fed's reaction function of this, it could actually cause the Fed to stay on hold for even longer, which is not really what the administration is hoping for. But if you do see any sort of boost to growth, if you see any sort of boost to inflation, then that would keep the Fed right where it is. So we're probably going to stay in this high for longer environment, not only when we think about policies like tariffs, but also when we layer in potential tax cuts and spending cuts.
And what's been the reaction from the Treasury market, and where do we go from here?
From a U.S. Treasury perspective, for many years and decades in the past, you did have this idea of so-called bond vigilantes, really chastening the Congress people in terms of their spending because bond yields would rise in response to higher debt and deficits. But we haven't seen that in a long time because from the financial crisis to very recently, we had zero or ultra low interest rates. So it's not about the total amount of debt you have, it's about the cost to service that debt. And that cost to service debt was pretty low. Now that interest rates have risen, interest payments have actually doubled since 2023 and tripled since 2021. And bond markets are taking note. Really, since fall of last year, you've seen Treasury yields start to move higher. Usually longer-term Treasuries or intermediate-term Treasuries are influenced by growth and inflation dynamics, but there's sort of this everything else bucket of rising term premium, and that is something that you have seen on and off over the last 6 to 8 months. Because if you are a holder of U.S. government debt and you can see that the federal finances are deeply unbalanced and that the Fed is no longer the biggest buyer, then you might want more compensation for holding that debt. And you might not want to pay as much for holding that debt. So you've seen that upward move in treasuries, and particularly as the House passed the One Big Beautiful Bill, you saw a spike in 30-year treasuries to above 5%, and you saw the 10-year move to about 460. So even in an environment where we could be seeing slower growth over the course of this year, potentially reverse course a little bit into next year with some of the stimulative impacts of taxes, you're seeing that the overarching response from a treasury market perspective is for yields to move higher.
Meera, thank you very much for joining us today, and we look forward to have you on this show again soon. I'm sure there's plenty to talk about from the US in the months ahead. So thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues, and of course, consider subscribing. Any other topics that you want to hear from us or wants to cover, please reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you next time to discuss what's on the investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.